Hello and welcome to the Money Street. In today's video we are going to explain what ETFs are and their main characteristics. Let's start by explaining what ETFs are. ETF stands for exchange-traded fund. Exchange-traded funds are financial assets that evolve like a stock market index and therefore replicated. Stay with us to learn more about ETFs and how to benefit from them. Compared to other stock index products, ETFs have a very low tracking error, i.e. a very small discrepancy with the index. The tracking error is mainly due to the transaction costs involved in buying and selling each of the securities that make up the index. ETFs are, like stocks, tradable daily on the market and are listed on the secondary market, which allows us to know their value at all times. These first two characteristics make them quite different from mutual funds, which can only be bought and sold at the end of the day once their settlement value has been calculated at the end of the stock market session. ETFs are passively managed investment products, as they only seek to copy the performance of the index. This is why in ETFs there is no such thing as a fund manager doing stock picking, i.e. choosing the fund's securities individually in an attempt to beat the index. The adjustments usually take place in a computer system, which trades automatically and saves costs, so the commissions are usually much lower since there is no need to pay the figure of the manager or managers. The only drawback of ETFs compared to mutual funds is that, in some countries, in traditional mutual funds it is possible to move money from one fund to another without paying tax on the profits made until the final sale of the fund shares. With ETFs this is not possible. You cannot transfer the money from one to another since you have to sell first and then buy to transfer the money to another ETF, which means that in some countries, as we have already mentioned, you have to pay taxes on the profits of the sale, thus decreasing the assets. Next, let's talk about ETF replication methods. The creation of an ETF can be carried out in different ways or methods of index replication. There are basically two methods, physical and synthetic, which we explain below. In physical replication, the ETF management company actually buys the financial assets that are included in the index. Sometimes it is not possible to make a full physical replication of all the securities in the index, either because the index contains many securities and would result in high costs, or because the markets for some securities are not sufficiently liquid. In these cases, full physical replication reaches its limits, and analytical tools and mathematical optimization procedures are used to define the subset of the index constituents that will achieve a performance similar to that of the original securities represented in the index. This is called optimized physical replication or sampling. On the other hand, in synthetic replication, also known as swap, the ETF manager carries out an exchange with a counterparty, usually an investment bank. To this end, the manager can create a portfolio of securities of its choice, for example of large European companies, and undertakes to exchange with the counterparty the performance of this portfolio, which it has created, in exchange for the performance of the index in question. This financial exchange of returns is called a swap contract and is a very simple method as it is simply based on contracts. When comparing the synthetic method with physical replication, there is generally a disadvantage for the synthetic method. The counterparty credit risk. The counterparty credit risk is the risk that the counterparty, with whom a swap agreement has been reached, will go bankrupt during the life of the contract, and therefore the exchange of returns cannot be exercised. The physical replication method does not have this risk, since in this method the shares are actually purchased. ETFs open the door to a new world of investment opportunities, as they allow us to access a wide range of assets, which in many cases are difficult for individuals to access. There are many types of ETFs depending on the nature of the underlying assets of the indexes they represent. Equity ETFs, in which the performance of the ETF is linked to the performance of the stock index it represents. Fixed income ETFs, which are those that copy the indices of debt financial assets representing baskets of bonds or public or private obligations. ETFs on indexes according to capitalization are those that copy indexes representing groups of securities according to their market capitalization, small, medium or large companies. Currency ETFs, which copy indices of short-term government debt assets with the highest credit rating. National, regional, or global ETFs. Sector ETFs, which refer to indexes of different business sectors, such as the banking sector, the technology sector, the textile sector, among others. Commodity ETFs, which replicate indexes of groups of companies that work with oil, gold or wheat, among other commodities. ETFs with factor, which refer to indexes that represent companies that meet a characteristic or factor, such as quality factor or value factor. If you are enjoying this video and want to be aware of new videos, subscribe to this channel and turn on notifications. Special mention should be made of short ETFs, leverage ETFs and inverse leveraged or ultra-leveraged ETFs. A short ETF behaves opposite to the index. If, for example, we take the IBEX 35 as an index and it falls by 2%, this would mean that its short ETF would increase by 2% at the same time. Conversely, if the IBEX 35 rises by 2%, its short ETF would logically fall by 2%. A leverage ETF participates in an overproportional way in the profits or losses of the index. For example, if we have an ETF index to the IBEX 35 with a leverage of 2, and the IBEX 35 rises 2%, this means that the leverage ETF rises 4%. Conversely, if the IBEX 35 falls 2%, the ETF falls 4%. We benefit overproportionally if the index rises and lose overproportionally if the index falls. Ultra-leveraged ETFs are a mix of the latter two. Equity ETFs are composed of shares of listed companies. These companies in which the ETF invests, as usual, distribute dividends to their shareholders. There are two types of ETFs, depending on how the dividends they receive from the companies in which they invest are treated. Accumulation ETFs and distribution ETFs. Accumulation ETFs mean that the fund reinvests the dividends collected by the companies in the fund back into the ETF, increasing its share price. On the other hand, distribution ETFs, as the name suggests, distribute the dividends to investors. In the accumulation ETF, the dividends remain in the fund, and in the distribution ETF the dividends are distributed. The greatest advantage of ETFs is their diversification, or rather, their distribution of money across multiple sectors, countries or financial assets. This lowers the overall investment risk. The second advantage is the listing, which makes these funds very liquid and transparent. As they are listed investment funds and tradable in the secondary market, they can be bought and sold, or in other words, you can enter and exit the ETF at any time, making them very liquid financial products. At the same time, they are very transparent products since, thanks to the quotation, it is possible to see at any time not only their valuation, but also the basket of securities that make up the ETF. Another advantage is the low costs. As I mentioned earlier, ETFs are passively managed, and unlike other financial products such as mutual funds, there is no active fund manager or managers to pay. The manager of an ETF has to replicate the index only once and only act again when the assets of the index are modified. If we continue with our IBEX 35 example, when a company leaves the IBEX 35 and consequently one of the IBEX medium companies moves up to the IBEX 35, only then does the ETF manager have to act by selling the shares of the company that has left the IBEX 35 and buying the shares of the company that has moved up. Company that has moved up. If you have not yet subscribed to the channel, do not hesitate to do so and activate the notifications by clicking on the subscribe button to be aware of our videos and not miss any. We frequently publish new videos about financial products, investments, and investment strategies to make the world of finance easier and more understandable.